Welcome to This Explainer. Today, we're diving straight into Amneal Pharmaceuticals. We've got some massive Q1 earnings to unpack, plus a blockbuster acquisition that is literally shaking up their entire business model. If you've ever wondered how a traditional generic drug maker tries to vault into the high-stakes, super lucrative world of biosimilars, well, you're going to want to pay attention to this one. It's a fascinating story of rapid growth, really ambitious scaling, and, let's be real, the heavy financial gravity pulling at them in the background.
Here's our roadmap for today. We'll kick things off with the Kashiv BioSciences acquisition. Look at the Q1 2026 record financials, check out the biosimilar growth engine, face some tough debt and balance sheet realities, and wrap up with the future outlook and risks.
All right, let's jump right into Section 1, the Kashiv BioSciences acquisition. This is the strategic pivot that's redefining the whole company.
$750 million. Let that number sink in for a second. That is the massive upfront price tag Amneal is paying to acquire Kashiv BioSciences. It's not just a purchase, it's a completely defining transaction meant to transform Amneal from your everyday generics company into a fully integrated global biosimilars powerhouse. We're talking 12 years of R&D, over 600 employees, and global manufacturing sites all brought completely in-house. Now, to really grasp what Amneal is getting for all that cash, we need to talk about biosimilars. Basically, these are highly similar, cost-effective alternatives to complex biologic drugs. Think of biologics as being made from living organisms. So, unlike a simple chemical pill like aspirin, they are incredibly complex and super expensive to make. Amneal isn't just buying a portfolio of products here. They're acquiring the highly specialized, rare infrastructure needed to actually mass-produce these high-margin medicines. It's like buying the entire golden goose, not just the eggs.
But look at how they structured this deal, because it's actually pretty clever. They balanced the risk using a 50-50 mix of cash and equity for that upfront payment. Yes, that means an 8% dilution, so existing shareholders are taking a slight hit to their ownership value. But check out the safety nets. The deal heavily ties future payouts to actual performance. We're talking up to $350 million in regulatory milestones, plus gross profit royalties stretched out over a 12-year period. Basically, it protects Amneal's balance sheet if the drug pipeline stumbles, but heavily rewards Kashiv if these products actually hit the market.
Moving right along to Section 2, Q1 2026 record financials, let's see how the core business is actually performing right now. Okay, this chart right here, this is the ultimate bull case for the stock. We're seeing fantastic double-digit bottom-line growth, even while top-line net revenue is growing at a much more modest 4%, hitting $723 million. Look at adjusted EBITDA, which is basically their core operational profit. It's up an impressive 19% to $202 million. And adjusted earnings per share skyrocketing by 29%. It clearly shows Amneal is expanding its profit margins and squeezing a lot more value out of its operations. In fact, management is so confident, they actually raised their full-year guidance. So where exactly is all this growth coming from? If we break it down by segment, that massive 23% jump in specialty is the real star of the show. That's driven heavily by the adoption of new drugs like Crexant, pulling in $21 million, and the rapid uptake of Brechia for cluster headaches. Meanwhile, their legacy affordable medicine segment chugged along with a steady 2% growth, thanks to ADHD and women's health products. And hey, if you're looking at that 4% drop in AvCare, don't sweat it. Management explicitly said this was a planned strategic cut to low-margin distribution, completely by design to boost the overall gross margin. All right, let's look at the long-term vision in Section 3, the biosimilar growth engine. This is where things get really ambitious. The company is betting the house on what management loves to call the golden era of biosimilars. Why? Because over the next 10 years, an estimated $300 million worth of worldwide biologic drugs are going to lose their patent protection. That is a massive opportunity. By bringing Kashiv's R&D in-house, Amneal is perfectly positioning itself to capture the full economics of these incredibly lucrative markets, instead of having to split the profits through licensing partnerships like they used to do. And this timeline lays out their exact game plan. For 2026, they're gearing up for key regulatory approvals for biosimilars of lanreotide and Xolair, operating with about 26,000 liters of manufacturing capacity. Fast forward to 2028, they plan to nearly triple that capacity to 75,000 liters while simultaneously shrinking their debt leverage. And the ultimate prize? By 2030, they're targeting between $1 billion and $1.3 billion in standalone biosimilar revenue, fueled by a pipeline of over 20 different programs. Talk about going all in. But, every explainer needs a dose of reality. So here's section 4, debt and balance sheet realities. Time to look under the hood.
This is where we see a truly fascinating, kinda stark dichotomy. On the left side, you've got this beautiful, highly profitable income statement. Gross margins and affordable medicines expanded to 47.3%. Awesome, right? But look at the right side. You have a balance sheet that is still heavily burdened. Specifically, Amneal reported negative $45.4 million in common equity in Q1. That negative equity is a huge red flag showing that the company is still dragging around the weight of historical debt and past acquisitions, which fundamentally limits their financial flexibility going forward.
And it gets a bit more complicated. Despite all that net income growth we just celebrated, Amneal's operating cash flow was actually negative $26.7 million in the first quarter. Wait, why is a profitable company burning through cash? Well, it mostly boils down to massive swings in working capital. We're talking huge sums tied up in accounts receivable, over $851 million, and inventory sitting out over $641 million. Converting those awesome paper profits into actual spendable cash in the bank, that's still a major hurdle for them.
Now, when discussing this debt load, management really prefers to point you toward adjusted EBITDA, that core profitability metric we talked about earlier. And they were super proud to note that their net leverage ratio dropped to 3.5 times adjusted EBITDA in March. However, they are totally transparent about the fact that funding this Kashiv deal is going to push that leverage right back up to 3.7 times by the end of 2026. Only after that do they hope to start deleveraging again.
And the independent analysts at S&P Global Ratings? They hit the nail on the head regarding this duality. Sure, they validate that the company has adequate liquidity, meaning they have enough cash and credit lines right now, but they clearly label Amneal's overall financial risk as aggressive. They even estimate that in a simulated default scenario, recovery expectations would only be around 40%. It's a stark reminder. The operational engine might be revving high, but the financial chassis is still hauling a very heavy load. Which brings us to our final part. Section 5, Future Outlook and Risks. Let's talk about what this all means moving forward.
While the story of shifting into high-margin specialty drugs and biosimilars sounds amazing, as an investor or observer, you've got to watch these 4 crucial warning signs. First off, can they fix that cash flow conversion issue? Second, the sheer execution risk of developing and launching 20 complex biosimilars is sky high. These are not easy drugs to manufacture. Third, they still have to manage that massive $3.5 billion mountain of total liabilities. And fourth, can these high-margin specialty drugs grow fast enough to outpace the ruthless pricing pressures that keep suppressing margins in their older generic drug business?
The financial researchers at Simply Wall Street highlighted this exact tension brilliantly. Look, the U.S. generic drug market is notoriously ruthless when it comes to pricing. Amneal is basically trying to outrun that deflationary environment by sprinting toward the high-margin biosimilar horizon. But if their core generics business starts taking on water faster than those new biosimilars can generate cash, well, this entire grand strategy becomes exponentially harder to pull off. And that ultimately leaves us with the billion-dollar question, the one that will absolutely define this company over the next decade. Can Amneal's new vertically integrated biosimilar engine outrun the heavy anchor of its balance sheet debt? They clearly have the roadmap, they have the infrastructure, but in the ruthless pharmaceutical market, execution is literally everything. Will this golden era of biosimilars be enough to save them? I'd highly recommend keeping a close eye on their future filings to find out. Thanks so much for joining me on this explainer, and I'll catch you next time.